everyone. My name is Paul Graham, and this is the Investor's Guide to Joy, a podcast where we're talking to people in the investment and investment adjacent space to really help you with your journey on both finances and the mindset as you accumulate those finances, pursuing this thing called joy. It is now the start of 2025, and I'm excited to release this episode and excited for a number of other updates that you'll be seeing in the future with episodes to come. There's been a lot of things I've learned from doing a podcast thus far. Part of it has been which format I like to do, which topics I like to talk about, and also what do people care about and what do they want to learn and know. That sort of like intersection has been really exciting to feel and see. And so this has been the last kind of format that I'll do in this sort of aspect. And so we're going out with a bang. This is going to be taxes. Taxes are a bang. They're something that ultimately we are able to strategically be aware of and overcome. I don't want to say the word avoid, right? But they're also something that, if not understood, can have massive implications. The implications being, one, if you're not paying for them, right? Which we'll talk a little bit about today, but also how to understand like what are things to get around and ensure that you are able to save maybe 10 to 30% of taxes. I'm going to ask a lot of questions specifically in this about like the IRS itself. To me, it's a big, scary place that I never want to meet anyone with. And actually, Bob used to work for the IRS. So we're going to talk through a number of different things with that. So whether you are an individual who has back taxes, whether you're an individual who wants to learn more about kind of the IRS and taxes in general, specifically about auditing, this was a big question that I had, or maybe you're just curious in general, this is going to be a fantastic podcast for you to understand. For those who have high incomes and are looking to offset their taxes, we just closed out 2024. And now as you're talking to your CPA or looking at the taxes that you paid or, will pay for this upcoming year, definitely an opportunity to consider investing in oil and gas. One, for the cash flow, and two, for the offsetting of taxes. Now, these are passive investments that could be done. I'll include some links if you want to learn more about it. It's something I've been helping people with for a couple of years now. And with that, let's get into it. And I'll save other notes for other times. Today, I have Bob here. Bob and I have known each other for about a year, I would say, from the GoBundance community. And we talk a lot about, what investors are experiencing and what maybe kind of laws or changes like could come into effect for, big scary things related to the place called the IRS. So have Bob on here today to talk about his experience and a lot of aspects of things not only we should think of and be aware of, but then also if we are in a situation of back taxes, kind of what to do and things like that. So Bob, glad you're here.
Thanks. Pleasure to be here.
Yeah. So, want to talk about, taxes, but not taxes in the sense of like, preparing, right? Or like tax planning. This is essentially when you're like not paying your taxes, right? Like that's sort of your specialty.
Right. Yeah.
Okay. Yeah. So tell me a little bit more about your career experience, because it's, interesting, I would say, than most lawyers.
Yeah. So after law school, I got a job with the IRS.
Okay.
Worked for them for 14 years, and I was a trial attorney for them. So that got me a lot of good experience. And then about 11 years ago, maybe 12 years now, I hung out my own shingle and started my own practice. So I help people who owe the IRS money. Maybe they haven't filed in a few years. Or I also help people who are being audited.
Okay.
And I do innocent spouse too.
Okay. Yeah. I mean, so it's not something I've experienced, but because I, certainly want to, pay my taxes. But for those who like aren't or not paying their taxes, like, is there a typical reason why they're not?
Well, sometimes you'll have a new business and maybe the first year you don't make any money. So you think, oh, I don't need to pay taxes or file taxes. And then the second year you make a little bit of money, but you've already started the pattern and then it snowballs. So I see people who've had a business for 5 years and haven't filed. Another thing could happen is, some big traumatic event like a death in the family or a divorce. And sometimes it's hard to get back on track.
Okay. And is it mainly like from the ability to have bookkeeping to understand what their taxes are, or are some people just completely avoiding what their taxes might be and therefore they're not filing them? Do you tend to find people actually know, or do they just completely avoid it?
I see both. If they haven't filed it a number of years, usually they haven't kept good records.
Okay.
So that's one piece of advice I'd give, all business owners is keep good records keep a QuickBooks account. It's fairly inexpensive and fairly easy to do. And
Yeah.
it's really hard to go back afterwards. And some people try to use an Excel spreadsheet or their bank account, that's just not the best way.
Yeah. Okay. So yeah, it definitely seems like a record keeping type of, software, right? So QuickBooks, I'm using Zero. So that's a good way. Like, what would you go in terms of defining good record keeping? Because I've learned over the years that could be potentially different in terms of maybe how a business owner thinks and how maybe a, CPA thinks, but also like how the IRS thinks. So what have you found is kind of the definition of like good record keeping?
Well, the main thing for the IRS is just keeping track of your income and expenses. So just pretty basic like that, keep track of receipts. But you'd be surprised how many clients I have who get into audits and they just have no records at all, or they try to use the Excel spreadsheets to keep track of things. But you're really required to keep what they call a general ledger, which is a list of your income and all your expenses and some kind of profit and loss to know what kind of money you're making. And that's just good business practice too. But
Yeah.
that is what the IRS requires. And if you don't do at least that minimum amount, they might find you liable for fraud. They might say it was intentional. It's kind of a big deal.
Yeah. I mean, what is there a way to know in like definitely like to, I guess my question is more like, are you proven innocent or are you innocent till proven guilty? Or are you guilty until proven innocent as it relates to, fraud with the IRS with record keeping?
Well, for fraud, you are innocent until proven guilty.
Okay.
What they would look at would be called badges of fraud.
Okay.
And they'd look at maybe if you have large deductions that are unwarranted, kind of a pattern of understating income. And, if you haven't filed returns, and a lot of those badges of fraud, if severe enough, they could be criminal. So, technically not filing a return for 5 years intentionally, that could be criminally fraudulent. I was at a conference recently and they were talking about that. But generally, as long as you file your returns, if you're contacted by the IRS, they generally don't go for fraud. They don't usually pursue that unless there's some other evidence, like you're keeping two sets of books, or you're trying to
Sure.
hide your income, or something like that.
Yeah, certainly. And there's other things at play. I mean, if someone were hit with an audit, I guess first, how often do audits happen? Like, is it one of those things that like everyone could expect to be audited, once in their life? Are there type of investments or investors who are, more likely to be audited? What have you found?
It's less than 1% of all returns are audited, so it's a fairly low amount.
Okay.
There are certain kinds of businesses like S corporations, which have a higher rate of audit. There's also some things you can do that could cause you to be audited. So the IRS puts all the returns into their computer system and they look for patterns, and they look for patterns where income might be understated. So what I've seen sometimes is people, like with their own business on a Schedule C, say they have a certain amount of income, they have expenses. Well, they claim their expenses up to their income. So they put an equal number for their income and their expenses, and just net it out to zero. That's a big no-no. That's a big red flag to the IRS.
Okay.
Because it's round numbers and it's looking like you're estimating, and no one's income exactly equals their expenses. That never happens. So
Yeah.
that's something to watch out for.
Sure. I mean, yeah, definitely starting a business is tough. Fun, tough. For those that are, running negatives for, maybe the first couple of years, like, are there, concerns there? If everything's all documented from an income, profit loss statement aspect?
Well, not necessarily, but if you
Okay.
did have losses for, 3 years or 5 years, and you have other income, they can call it a hobby loss. So, and disallow your losses because it's a hobby. So, for instance, sometimes maybe someone who's a dentist making a lot of money, they'll buy a farm and they'll start raising horses and they'll set it up as a business, and then it has losses and they offset that with their income. That would be kind of a typical hobby loss, but you could be I've had clients who are race car drivers, horse racing, different things like that. But so typically it's fine to have a loss, but if you have losses over a number of years and they're being used to offset other income, that can be an issue.
Okay. Other income, because I'm thinking of like, for example, short-term rentals are, a dime a thousand, right? So people are getting into them. They want the passive losses because of the short-term rental loophole. But then from that, they're, maybe, adding to the property or something like that. And, the revenues aren't, producing. In the heyday, like you knew pretty much kind of what the income was going to be, and it did pretty darn close to that. These days, it could, stay within that or it could decrease. So my question is like, as people are investing in, short-term rentals or maybe like uniquely designed long-term rental, or more importantly, like co-living or even like furnished midterm rentals, right? Those things are going to have not just high purchase, well, maybe not high, but just like you purchase the darn thing, then you're furnishing or updating it or doing some changes, right? Having these, losses that could potentially like outweigh, the income. If someone has that property for several years and they have constant losses for each, does that raise maybe like a red flag, or is it just a yellow flag? Certainly there's different nuances in this, at least is my thought, unless there's like a definitive, like this is good and this is bad. I'm just thinking it's kind of a general, like, hey, this could maybe be an issue, but what I guess have you found?
Yeah, so the main thing in that type of situation, if you're having losses, but you expect to have a profit over the long term, is have a business plan and show, like if you were asked, okay, it's going to be unprofitable for 7 years, but then in the 8th year, I'm going to turn a profit. Or, in the hobby loss cases, one of the factors is, you can invest in assets that expected to increase in appreciation over time. So that's not a hobby loss. If you're having losses now, but over the long run, it's going to make a profit, that's fine.
And are hobby losses like bad, illegal, frowned upon? They just need to be aware of them. Like, tell me more.
Well, they're bad, I guess, in the sense of like deducting expenses without a receipt is bad. The IRS can disallow the deduction for that situation. For a hobby loss, they can disallow the expenses and, just say, okay, you made this amount of income. We're not allowing any expenses for this hobby. So that would be an audit.
Is that to say, like, to your best of knowledge, if someone's like wanting to be a content creator, they, buy some, camera or lights, and then they go spend, $10,000 on a, mastermind type course sort of thing, right? They make dollars that year. Is that like, I guess my question is simply like, is there a definition of what a hobby loss is? Because that could be like someone's like, hey, I'm definitely doing this. This is my business type of thing. But, to the IRS, that could be viewed as a hobby. So is there a definition to hobby loss? And then that just example I gave, is that considered one or not, or you need more information?
So you have to have for business, I'll back up to that. You need to have regular activities engaged in for business with the intent to make a profit. So if you're going into it with an intent to make a profit, then it's not a hobby loss per se. So a hobby loss is defined as something that's not intended to make a profit. And they look at all the different factors. But they have held that businesses like Amway, those are routinely considered to be hobbies because people go into it and lose a lot of money, and there are some elements of pleasure with it. And the IRS looks at these conferences, like you mentioned, a conference. They don't necessarily see that as business always, if it's also a lot of fun. I had a coaching program I was a part of almost 10 years. And luckily I was never audited, but I always kind of figured we tried to make it so that it would be deductible. But if I was ever audited, I suspect that they would have looked at that carefully and they may have not allowed that.
Okay. So, I mean, something like GoBundance that, we're in, I mean, that's like, mastermind, like business-esque, but I mean, we have fun, but like, what is that? Are there strict definitions on this, or is it just a general, like, it depends on the details sort of thing? I'm curious because it's almost making me think like, is all education actual education, or is it really just, hey, I'll just spend a bunch of money, write it off, and then hopefully I don't have to explain it sort of thing?
Yeah, so it depends. I mean, I would say for something like a GoBundance event, you'd want to have an agenda with what you did throughout the day and really show that there were business reasons for it, the education, and Also, the networking, that can be a marketing expense.
Okay.
So you might say, these are the people I've met. When I've been involved with audits, when these types of things come up, it's usually years after the fact, and usually the person I'm helping doesn't have the documentation or really the descriptions. So that can be a problem. But if you keep an agenda and keep your receipts, what you paid for it, then you should be fine.
Okay. So the agenda seems like an important thing, as well as like people you met as well
Right.
to that. But I mean, say I don't. Say I'm just like, you know what? I never look at that email. I can't look at that email. I don't know the agenda. They changed the web page. I can't remember when I met who type stuff. I get audited. What sort of like cost or range of cost is maybe kind of reasonable to expect? Like to my understanding, if someone were to, get a DUI, unfortunate, and they're hopefully they're alive, to then say I've heard it's about $10,000. So I'm curious, like what sort of like typical or maybe like range would be an audit if someone was hit with one?
So for that, they'd be disallowing the expense. So, they might allow the conference fee, but they might not allow the travel, the plane ticket. They might not allow the hotel room, or they might allow it for part of it. I think the rule is, and I don't always do this, but if you're somewhere for more nights for work than for pleasure, you can deduct the trip. A lot of people give that advice. So say
Okay.
you're at a conference for 4 days and then you take 2 days afterwards and sightsee. So they might kind of split it and allow part of it and not other part of it. Yeah, but as far as the amount, you're looking at whatever your tax rate is on that deduction that you're not being allowed.
Okay. But I mean, is that just to say that, beyond just the headache and the fact, of your time, right, that's being taken, if someone has like a loss and then they, you do get audited and then, some of those losses are removed, but you still have a loss, there's still no taxes due by that definition. So is there like any initial like penalty or something like that in terms of fine? Like in that sort of example, it's to ask the question, every time someone is audited, are they having some financial repercussion, or is it just a time piece?
It typically would be a financial piece. You could have some penalties, 20% penalties on deductions you shouldn't have taken. But the IRS, their job is to collect money. So their goal in auditing you is to collect money. And if there's no money there, they're not going to audit you. Now,
Sure.
if they don't find any adjustments and they don't collect any money, then it's called a no change audit. And that does happen quite a bit. But the IRS's intent is actually to not have that happen.
Okay. Yeah. I mean, from like a personal time standpoint, like what type of audit timeline is this? Is this like a 2-day thing, a 2-year thing? Certainly it's going to depend on the complexity of the individual, potentially like, how much they have in terms of like, net worth, as well as in terms of like transactions, as well as the complexity of their legal structure. Because I'm assuming that if I get audited for maybe like one company, it's going to be like all companies and things that I'm associated with, or is it just that one if they have some sort of cause for it? And then they would have to get cause for like other entities and things like that.
Yeah, it's usually just on a per entity basis. So they might audit, but then they might ask for returns from related entities and they'd look to see if they wanted to audit. But there's three kinds of audits. There's a
Okay.
correspondence audit, there's an office audit, and then there's a regular audit. So correspondence is just when they send you a notice in the mail and they say want, excuse me. So a correspondence audit is conducted over the mail. Say
Okay.
there's one expense that they're questioning and they want you to provide a receipt. You can send that in to them, and that usually resolves it. It could also be something like a math error, although that's not always called an audit. So that an
Okay.
office audit is a little different, is when they're auditing your return, but they usually ask for a certain number of documents, and it's typically they send this out originally by mail, but then they set a date and they want you to bring all of that into the office. And then usually that's about a 2-hour audit. And they go through your documents with you and you explain what the different things are. And then they make their adjustments and it goes from there. The
Okay.
third kind is where it's a field audit, where they would actually come out to your place of business and want to look at your records there, and where it's actually a revenue agent assigned to your matter. So that's kind of the most serious. I mean, that can take, typically that might take 6 months to a year. It can take up to a couple of years, but typically they like to try to get it resolved within a year.
Okay. Yeah, I mean, I've seen that episode of I think it was Suits, or anyways, just some move where it's like, yeah, we'll just bury them in paperwork, but that might have just been a law thing, not a tax thing. So I mean, to the average person, like, I mean, less than 1%, but certainly we don't want to have like this types of issue. I mean, how when you're audited, are you more likely to get audited again, or how does that kind of impact? Are there any like repercussions, right? Like, does this somehow go on your credit report? Like, what happens after?
No, it doesn't go on your credit report. So if you are audited, I think you typically are more likely to be audited again, especially if they find some adjustments. I don't know why
Okay.
that is, but it just, in my experience, that seems like it's the case.
Okay.
If they do audit you, I think it's 2 or 3 times without having an adjustment, then they're not allowed to audit you again. So,
Okay.
but it doesn't go on your credit report. You have to pay the taxes, but it's all, the IRS is very careful to treat all your information as confidential. So yeah, that would become public.
Okay. I mean, the other question is just like, what do you see in the sense of like, audit fees? Like, call it an 8-figure business, like they're potentially, getting hit with a, I don't know, like $1 million, like, piece. I mean, granted, it depends on the, obviously if there's fraud, that's different, or just like miscategorization or things like that. But I'm really curious to just understand more of like, how big of a concern is this to someone from like the 8, 7, and 6-figure level? Is there some kind of like ratio of sorts that kind of is just like average or something like that? Because for, people who are the 6-figure earners that have, families, they have maybe the short-term rental or a couple properties, or maybe it's a syndication or something like that. But they could, be worried, and rightfully so. We need to categorize things as we talked about. But is it to say like, if I'm audited, I should, kind of expect, like a couple grand, if you will, if I'm a 6-figure person, and like tens of thousands if it's 7? Or like, what have you kind of seen in just like rough sort of averages of kind of the financial repercussions that, could be, even though it's obviously really specific and depends on all these cases. But again, I'm just trying to get like a sense of what that roughly typically tends to look like.
Yeah, I don't think I can really answer that because it's really dependent on what adjustments they find,
Okay.
and specifically like what deductions they might disallow. That, yeah, there's not really, I mean, it could be $10 million of income and it could be a no change, or it could be a huge bill. So yeah, I don't think you can really say.
Okay.
Yeah, it doesn't really
Yeah, it's
depend
just
on how much they're making. It depends on what the issues are in that case.
sure. Okay. Now, if someone gets, hit with an audit, like what sort of options do they have? Is it just, I mean, granted, it's going to depend on like the type, right? But, is it just work with someone like yourself, or, deal with it personally? Like, are there, other options?
Yeah, so if it's a correspondence audit and you know what the documents they need are, you could probably handle that yourself.
Okay.
For an office audit, I've been brought in, but typically if you had someone prepare your return, they could handle it for you. And even with the field audit, most people, if they had someone prepare their return, they're the first line of defense. They know what's on the return, they know all about it. But if it's going to go unagreed, that's when it'd be good to bring in someone like me, because I could
Mhm.
help go to appeals and argue the case. So yeah, and even with an office audit, if you have some issues, like say you didn't report something. So for instance, say you filed your tax returns, but you didn't report your cryptocurrency. I would get someone like me involved there, because that's, potentially fraudulent if you intentionally didn't report that income.
Okay.
And you just want to be careful because there's those issues there. So yeah, you can bring in someone like me, but I'd say more if there's issues, if there's things you don't want the IRS to find or that you're concerned about, bring someone in because you don't want to say the wrong thing. So for instance, like with the cryptocurrency, they
Yeah.
might ask you, they probably would ask you, well, why didn't you report that? You need to be careful. You need to have some common sense and say, well, like, I forgot about it, or, oh, I meant to do that. But if you say, well, I knew I had that, but I didn't want to pay the money on that and I didn't think you'd catch me. Well, that's fraud. So yeah, it's just, you need to be careful.
Yeah. And is that just on crypto gains, or is that just even investing in crypto?
There'd be gains if you had
Okay.
like
Okay.
sales
From
and
the sale of it. Okay.
yeah.
Gotcha. Okay. I mean, what kind of repercussions are there for not paying, tax bills? Is this like, hey, they could just, I mean, this is probably like a tax lien type thing, right? Where, someone just come in and say, take a property or something like that. But is there, I mean, certainly there's fines, but is there jail time too? Like, what are we looking at here?
So first of all, if you don't pay your taxes, well, the IRS will send you a number of notices stating,
Hmm.
okay, this is how much you owe. Please pay it by this date. And if you continue not to pay, eventually they might file a lien if you owe over 50,000. And then, if they filed it with the county, then if you sold real property, you would have to pay the IRS from those proceeds.
Hmm.
And if it gets even more serious and there's a lot involved, they could levy your bank accounts. But there are a lot of steps in between. And usually where people get in trouble are when they're ignoring the IRS. And usually jail time is only if you're doing something really intentionally. Say the IRS comes to you and says you need to file these returns, and you say, well, I don't think I have to. The income tax isn't constitutional, that type of thing. Where it's willful, that can land you in jail. Because the IRS is especially sensitive to people who have the type of constitutional arguments. But then also, if you're hiding income or even lying to the IRS, those types of things would
Okay.
land you in jail. But most people don't have to worry about that.
Sure. Yeah. Okay. Yeah. I mean, what has your experience been as it relates to, tax liens for, property? Like I know some people on kind of the abundant side that like buy them, but, curious what your knowledge has been from maybe kind of the other side. Like, do you come across this a lot? Are there things that investors should look out for that, you're aware of, or things like that for properties that have back taxes?
Yeah, I would just say check early because you can call, there's an IRS lien desk. You can also, with the title report, find liens because sometimes they find them at the last minute and then that can be a problem. But if you're purchasing or if you're selling the property and if the proceeds are enough to pay the lien off, then it's not really an issue. They'll just pay the IRS out of the proceeds
Sure.
and you'll take clean title. What's more of an issue is when the proceeds won't pay the IRS off or will only pay it partially. So sometimes the IRS will still release their lien if they think they're getting enough money. But that's definitely where you need someone like me to help you navigate, lien discharge or lien subordination or whatever you need.
Okay. And is that more on like people should contact you if they're looking to like buy lien properties, or you're saying if you have a property that has a lien against you to contact you, or both?
Yeah, if there's a lien against someone and they're
Okay.
selling their property, then that they would be the one to contact
Okay.
me.
So got it. So sellers are more the focus.
Yeah,
Okay. Nice.
but
From
a
like,
buyer too, if they're trying to work out a deal and
yeah.
the seller owes money and maybe the seller isn't willing to or not able to work something out or something. So
Yeah. I mean, as an investor, I mean, we've talked about a number of different ways and things to go about and think about this. Like, what are some maybe questions that I like haven't asked that like investors should really know, be aware of, or should not do?
I guess another thing to be aware of, we were talking about liens,
Hmm.
is businesses can have liens as well. So
Okay.
if someone sells you their business assets, and maybe they're selling you the whole business, maybe they're just selling you your assets, but if there's a lien that's been filed against that business or the owner of that business, that lien will follow those assets. So you need to get what's called a certificate of discharge to
Okay.
discharge those assets. And then typically what would happen is that when the purchaser pays for those assets, that would go to the IRS, the proceeds from that. And then they would discharge the lien as to the remainder of the amount owed. But that's something they can catch people unaware because that type of lien isn't always easy to find, and people don't always realize, oh, just that lien from this individual who owned this business, can stay with the assets even after they're purchased.
Okay, got it. So do liens then stay with individuals, not just companies?
Well, it's stay with the assets.
Okay.
So
But I'm
if it
thinking like
was
if Timmy and Sally own like this company and I just buy it from them and I may be unaware that there's a, lien, on the company or maybe them as individuals. I'm curious, like if I buy the company, like do liens go against individuals or like the company? Because if I'm buying the company, that means I'm buying the assets, which means I would need to, assume those, liens, but they would no longer be part of the company. And so, are those things that are like, I guess, do they have to be disclosed or like, how do I avoid a like, hey, I bought a company and oops, owe 70 grand of taxes or something like that, especially if it follows the assets of the company and these individuals can just, venture off.
Yeah, I would say I'm not sure exactly about if there'd be like a title report or title company might do some
Okay.
kind of search. You might try to do a search with the county records for that business and the individual, but the lien wouldn't be transferred to the buyer. It'd just be on the assets. But the problem with that is IRS can come in and foreclose on the assets.
Yeah, sure.
Yeah.
Yeah, and obviously you'd want that not to be the case because those assets, whether it be real estate, equipment, et cetera, that would ultimately be to operate the business, and so you want to have it aligned for that. As it relates
Right.
to, I mean, not paying taxes is not paying taxes, but in terms of maybe audits or other potential kind of legal issues as it relates to the IRS, are there certain types of investments that are like more problematic than others or asset classes, right? So single family versus plexes versus commercial or even like syndications, like anything else that or are there specific nuances that are unique?
Not that I can think of necessarily. There are a lot of passive loss rules, and if you're not actively involved with the business, there's a lot of rules with your realtor or your real estate investor. That's kind of beyond the scope of this conversation, but those are things to be aware of.
Okay.
Usually the laws kind of come in after the fact. There were a lot of tax shelters and things. I think it was the late 70s. And then they passed all these laws about passive losses and when you can take them and when you can't and all of that. So,
Yeah.
yeah.
Okay.
But
Yeah, it's interesting.
one thing I thought of when you were asking about that was, kind of like what happens if you're audited and next steps and all of that. If you do end up owing the IRS a lot of money, there are options. So there's really three main options. And one would be if you just can't pay at all, you could be put into a hardship status. That's also called currently not collectible. And
Okay.
then the IRS will come back in a couple of years and see if you're able to pay. The second would be a payment plan. It's called an installment agreement. And you can usually pay it off up to about 84 months. If you can pay it, just pay it all off within that time. If you can't do that, you can get what's called a partial payment installment agreement where you pay what you're able. And then there is a settlement option. It's called an offer and compromise. So
Okay.
say you've gone into business and it fails and you owe all these taxes and you're not even employed right now. The IRS will basically settle for what they think you're worth. So they'll look and see, okay, how much they think they could collect from you if they collected as much as they could right now. And so they look at your assets and they look at your income, and then they'll settle based on that. So I had a client who had his own business and had racked up some taxes over about 7 years and ended up owing about 110,000. And we were able to settle that for 10,000 just based on his ability to pay. So if someone finds themselves in that type of situation, maybe they just didn't work out or something, that would definitely be something to look at.
Yeah, no, it's a great point. You mentioned that years ago when I had a startup software company, I owed, about like 4 grand in taxes and ended up doing an installment plan. I forget the interest rate on it and, some of the details, but more or less to say it was like $60 a month or something like that. And so I think it was like 59 actually. I was actually excited. I was like, heck yes, totally. Here's money. There you go. And span of, that next year, things changed and I was able to, pay the rest in full. But it really changed like how I viewed taxes to the point where now as an investor, I'm more knowledgeable in terms of like losses, depreciation, things like that as it relates to, active income or passive income. The other piece is that if I'm somehow, wrong or things don't go well, whatever it might be, when I do owe taxes, like there's then that piece. And it's no longer this scary thing of like, oh my gosh, I got to sell my car just to like pay taxes to like live. And it puts just more of a comfort to know that there are options. Certainly depends on the case and all this stuff. I don't know. Do they give like installment plans or hardship? Well, I guess do they give installment plans or partial payments to everyone, or is it just to certain situations? Or
Yeah, they'll typically do a payment plan for pretty much anyone, but as long as they're able to pay it off within that time period. So
sure.
for the hardship or the partial payment plans, they will want a financial statement and 6 months of bank statements and really look at what you can pay. The other thing is the IRS has 10 years to collect from the time the tax is assessed. So if you owed for 2024, the returns due April 15th of 2025, they have 10 years, April 15th, 2035 to collect that. So if you had a bunch of money you owed for this year and you're going to wait till say 2032 and you have 3 years left, then that's going to be an issue. You're not going to be able to spread that out for very much, only for 2 or 3 years.
Okay, based on when that initially was filed.
Yes.
Okay. Got it. Yeah. And I can see how potentially like there's an issue because that means the IRS would go back 10 years. So if you're audited, they would go back 10 years in that entity.
No, the audit is a little different. They can go back 3 years
Okay.
or 6 years if there's a substantial understatement of tax, or if there's fraud, they can go back indefinitely. But for most of the cases, it's only 3 years they can go back. So they can audit back 3 years, but they can collect for 10 years.
Because we talked about investors and investments. Is there anything related to, say, like nonprofits or something that also happens as it relates to not paying taxes and things like that? Or either not, or, again, kind of the categorization sort of stuff. So same kind of questions we went through, but like for nonprofits.
It's pretty much the same rules. I've had some nonprofit cases where they owe taxes or being audited. It's pretty similar. Yeah.
Yeah. Okay. Well, that's good to know. Certainly for some, because I know some business owners or people like also have nonprofits or maybe do charity work or things like that. So great. Well, no, I appreciate you going through all this. It was super insightful for myself and gave some good insight. And it really put more detail on like what the IRS like can do, should do, things like that. And I was always thinking like IRS is would just be having an audit would be like the worst thing in the world. But to your point, maybe it's just to send a paper statement and call it a day. And certainly there's potential fines or things with it, but it's not like a again kind of DUI sort of equivalent of like, hey, it's going to be X amount. Like you might lose your business because of something you misreported or something like that. Fraud aside, right? And so just give you good understanding. Certainly no fraud, and certainly keep everything in a row. Especially as a business owner, then you can understand and see like what's coming, reflect how the year went, actually prepare for taxes, offset incomes as it relates to investing, with oil and gas or other types of depreciating losses. If you don't have those numbers, then you can't understand your taxes to then understand what to invest to kind of change those last minute pieces. So very, very insightful. For this last sort of question, just want to see like, so this is Investor's Guide like to Joy. What sort of mindset or mantra or quote or lesson or maybe rule of thumb comes to mind for you?
I guess I would say I don't have anything super profound or anything, but just keep abreast of what you're doing. If you're, don't put your head in the sand. Keep that. If you have a business, if you have employees, keep up with the payroll taxes because that could be a big issue. But and just keep abreast of it. If you have someone doing your payroll taxes for you, make sure they're doing them, and make sure you keep on top of your investments and know what's going on. And Because I think that the thing that I encounter the most that's the hardest is when people just kind of put their head in the sand and they don't want to deal with things. And
Sure.
yeah.
Okay. Yeah. And I guess is payroll taxes the same sort of thing that we went through other, investment or property type stuff in terms of keeping track of it, pay it, and there's options for it?
Yes. Yeah. There's less options with payroll taxes.
Okay.
But yeah, that's when you want to really keep abreast of it. I'm sort of adding a new topic here, but
Sure.
you can only pay those off with a payment plan if you owe less than 25,000 and only over 24 months. So if you owe more than that, they're going to want to come talk to you, and that's the one tax too that they could shut your business down if you're not staying current.
Okay.
So keep on top of it. Don't delegate that to someone. Don't check if your bookkeeper is doing it. Just make sure they're doing it and they're filing them.
Yeah. Okay. Yeah, that's a great knowledge piece for sure. Well, Bob, thanks for coming on and sharing your insight.
Yes, you're welcome. It was a pleasure.
Good deal. All right, thanks. Hey, one last thing before you go. I wanted to share my mission while on this earth, and it's to help educate investors about different opportunities, share mindset tips on how to change our perspective, and different things to really experience more joy in our lives. If this resonates with you at all and you enjoyed this episode, please share it with friends and others to help grow the community around the Investor's Guide to Joy. Leaving a 5-star review also helps grow the show and get connected to more people and share our experiences along the way. Thanks so much for joining, and can't wait for you to listen to the next episode.